Mercedes-Benz has just dropped an absolute bombshell on the global car market, and the shockwaves are spreading faster than anyone expected. Overnight, one of the world's most premium automakers, a brand built on exclusivity, high price tags, and decades of luxury dominance, has taken a turn nobody saw coming. Massive price cuts, aggressive discounts, and an all-out push to move inventory that has left analysts scrambling, competitors panicking, and Wall Street watching with raised eyebrows. This is not a small adjustment. This is a seismic shift. So what forced Mercedes-Benz into such a drastic move? The truth is, a perfect storm. Inventories across the luxury segment have quietly ballooned over the last 7 months. Dealerships are sitting on record stock, and interest rates have squeezed the upper middle class buyer who normally steps into a Mercedes showroom with confidence. Affordability is collapsing at the same time production is rising, and that imbalance is crushing margins. Mercedes is now in a position where moving cars is more important than maintaining prestige. They need volume, they need cash flow, and they need it now. But the timing is even more intriguing. Why now? Why is Mercedes choosing this exact moment to pull the trigger? Because the luxury EV race is turning hostile. Tesla's price cuts have already reshaped expectations. BMW and Lexus are quietly preparing aggressive 2025 launches. Chinese EV giants, especially BYD, are pushing into Europe with vehicles that undercut Mercedes pricing by nearly 40%. Mercedes knows that if they do not reset their market position immediately, they risk losing brand relevance in a rapidly shifting landscape. This is not about generosity, this is about survival. And what does this bold move mean for the US auto industry? Tremors. When a legacy titan like Mercedes cuts prices, every other premium manufacturer is forced to reevaluate its strategy. Audi and BMW will face immediate pressure. Lexus and Acura will have to rethink inventory cycles. Even non-luxury brands get pulled into this domino effect because consumer perception shifts. If a Mercedes is suddenly affordable, why would any buyer pay full price for a mainstream SUV? These cuts could trigger a nationwide pricing reset that the industry has been desperately avoiding for almost 2 years. Wall Street is paying very close attention, and the reaction is anything but calm. Investors are spooked because aggressive discounts usually signal one thing: weakening demand at the top of the market. If luxury consumers pull back, that suggests broader economic stress. Analysts are now questioning whether this is a Mercedes-only issue or the start of a luxury sector downturn. Stocks tied to dealership groups, auto lenders, and parts suppliers are already showing volatility. And if this discount cycle spreads through Q1 2026, Wall Street could see a steep repricing of the entire automotive sector. Now comes the question every viewer wants answered: should buyers take the deal? Surprisingly, yes, but with caution. If you have been waiting for a luxury SUV or sedan, these Mercedes discounts are some of the strongest the brand has offered since the 2008 financial crisis. Buyers can leverage deals, negotiate aggressively, and walk away with pricing that would have been impossible even 6 months ago. But there is a strategic warning: if this pricing war continues, the discounts may deepen. Anyone not in a rush could see even better deals as Mercedes tries to stabilize inventory through the first quarter of 2026. And this leads us to the real consequence. Mercedes' decision is not just about selling cars, it is about protecting the long-term viability of the brand. For decades, Mercedes has relied on an aura of untouchable prestige. Higher prices meant higher perceived value, but this shift, if not carefully managed, risks eroding that image. Once consumers realize Mercedes is willing to discount heavily, they may no longer view the brand as an aspirational luxury purchase. This is what analysts call premium dilution, and it can take years to reverse. That is why every executive in Stuttgart is walking a tightrope now. Push too hard on discounts, and Mercedes becomes seen as a value luxury brand rather than a global luxury icon. Meanwhile, dealerships are navigating their own challenges. Many stores placed massive orders during the post-pandemic demand boom, expecting sales to remain elevated for years. Instead, they are now sitting on 60, 90, even 120-day inventory levels on some models. Floor plan costs, the interest dealers pay on unsold cars, are exploding. Mercedes corporate knows that if they do not support dealers with factory incentives, many stores will drown financially. So these discounts are not acts of generosity, they are lifelines to prevent dealership distress. Competitors, however, are watching every move. BMW cannot afford to fall behind. Their US sales momentum is fragile. Audi has struggled for years with inventory management and now risks losing even more share. Lexus, known for its reliability advantage, suddenly looks overpriced next to a discounted Mercedes. You can already see early reactions, ramped up loan incentives, whispers of 0.9% APR coming back, and dealer-level markdowns quietly popping up across the luxury market. Mercedes has basically pulled the pin on a pricing grenade, and everyone else now has to pick up the pieces. But the financial ripple effect goes even deeper. Auto lenders are recalibrating residual values on leased Mercedes vehicles. If discounts remain aggressive, the projected value of these cars 3 years from now will drop. And that creates losses for leasing companies, banks, and even consumers who financed at peak pricing. This is why Wall Street is uneasy. Lower residuals mean higher losses mean tighter lending, and tighter lending slows auto sales. The Mercedes discount strategy could unintentionally tighten credit conditions across the entire sector. Yet at the same time, for everyday consumers, the opportunity is undeniable. Incentives on the GLC, GLE, and E-Class are reaching levels unseen in over a decade. Buyers with strong credit can negotiate from a position of strength. Dealers know the pressure they are under, and that means even deeper behind-the-scenes markdowns are possible. Smart shoppers are arriving at dealerships with data, comps, and loan approvals ready, and they are walking out with deals that would have sounded impossible just a year ago. The big question now is whether this is temporary or the beginning of a structural shift in luxury pricing. If this trend becomes structural, the luxury market as we know it is about to reshape itself entirely. For years, Mercedes and its rivals operated under the assumption that luxury buyers were insulated from economic pressure. They believed that premium customers would continue spending, regardless of shifts in interest rates or inflation. But the recent slowdown has proven otherwise. Even affluent consumers are pausing, reconsidering, and delaying purchases. This is a dramatic psychological shift. Luxury is no longer immune, and Mercedes is the first major brand to publicly acknowledge this by slashing prices rather than pretending demand is stable. The implications go well beyond dealer lots. Automakers have built long-term plans on high-margin EVs, expecting these models to drive profitability for the next decade. But if Mercedes is already discounting its EV lineups, especially models like the EQE and EQS, then the entire EV profit model is under threat. EVs are expensive to build, and without premium pricing, the margins collapse. That forces automakers to rethink R&D spending, battery sourcing, and future production capacity. What Mercedes is doing today could force the entire industry to recalibrate how quickly and how profitably they transition to electric. Then there is the geopolitical angle. Chinese automakers are slowly capturing global markets with aggressively priced EVs that match or outperform European luxury brands. Mercedes knows this. BYD, NIO, XPeng, they are all expanding internationally with vehicles that cost significantly less but deliver cutting-edge tech. If Mercedes waits too long, they risk losing the tech narrative and the price narrative simultaneously. This discount strategy is partially a defensive maneuver to hold onto market share before Chinese luxury EVs become fully mainstream in Europe and North America. Investors understand the stakes, and that is why the financial reaction is so intense. If Mercedes is forced into a discount cycle, then BMW, Audi, and Volvo are likely next. A domino effect could put pressure on parent company stock valuations, and if luxury collapses first, Wall Street views that as a potential early indicator of broader consumer weakness across the economy. Lower car prices might sound like good news for buyers, but for equity markets, it signals shrinking margins, lower earnings, and declining cash flow. That combination can trigger sector-wide sell-offs, especially for automakers, suppliers, and lenders. Buyers, however, are now entering a golden window. When a luxury brand begins discounting at this scale, there is often a brief period where the incentives are excellent, the inventory is high, and the competition has not yet matched the discounts. That is where we are right now. Consumers who understand negotiation strategy, timing, and model cycles can capitalize in a way that may not repeat for years. But this window will not stay open forever. Once competitors fully react, pricing across the board will shift and the advantage will diminish. Still, the true long-term question is whether Mercedes can maintain its brand perception while running a high discount strategy. Brand perception is Mercedes-Benz's most valuable asset, and every executive in the company understands that once you weaken the aura of exclusivity, rebuilding it can take an entire product cycle, sometimes longer. Luxury brands thrive on scarcity, status, and the feeling that not everyone can afford what you're buying. By offering deep discounts, Mercedes risks repositioning itself in the eyes of consumers from a premium luxury automaker to a high-end manufacturer chasing volume. And when exclusivity fades, loyalty fades with it. Buyers begin cross-shopping more aggressively, comparing Mercedes not just to BMW or Audi, but to upper-trim Hyundai, Genesis, and even mainstream brands offering premium interiors at lower prices. Dealers are already feeling this shift. Many are reporting that negotiation dynamics have changed almost overnight. Customers are walking in with a sense of confidence. They know Mercedes needs to move units. They know there's room on the price sheet. They know incentives are strong. This new buyer psychology is powerful. Once consumers get used to expecting discounts, it becomes extremely difficult to return to a high MSRP, low haggle environment. Mercedes may unintentionally be training an entire generation of buyers to expect deals, not desire exclusivity. On the product side, Mercedes faces another challenge. Several upcoming models, including next-generation EVs and refreshed luxury flagships, are expected to carry high development costs. If profit margins shrink today because of aggressive discounting, Mercedes has less cash flow to reinvest in innovation. That slows development timelines, creates pressure on engineering teams, and potentially weakens Mercedes' competitive edge in emerging technologies like advanced battery platforms, autonomous systems, and next-gen infotainment. The short-term benefits of clearing inventory may eventually compromise long-term strategic positioning. Still, for the buyer sitting at home watching all this unfold, a critical decision looms. Should they jump on the current discounts before they vanish, or wait to see whether Mercedes will go even deeper? Timing is everything. Historically, when a luxury brand initiates a discount wave this large, it tends to escalate for at least 1 or 2 quarters before stabilizing. That means early adopters will get strong deals, but patient buyers may capture even better pricing as inventory pressure intensifies. However, waiting too long carries its own risks. Limited color choices, fewer trims, and the possibility that high-demand models sell out before the deepest incentives arrive. The US auto market is watching Mercedes closely. If other luxury brands respond aggressively, buyers could see a rare luxury price war, something the industry has avoided for over a decade. And if that happens, the ripple effects will extend far beyond luxury showrooms. A luxury price war would send shockwaves through every segment of the US auto industry. Mainstream brands would suddenly face pressure from above, as consumers who once aimed for a Honda Accord or Toyota Highlander begin cross-shopping discounted luxury models instead. This demand shift could force non-luxury brands to introduce their own incentives, creating a cascading effect that pushes prices downward across the entire market. What starts as a Mercedes-Benz discount strategy could trigger an industry-wide correction that resets vehicle pricing norms for the first time in nearly 15 years. Suppliers and manufacturing partners would also feel the impact. Luxury vehicles typically generate the highest margins and fund the best technology investments. If those margins shrink, automakers may renegotiate supplier contracts, delay production launches, or cut back on higher cost components to preserve profitability. That could mean slower adoption of premium features, reduced investment in cutting-edge tech, and a more conservative approach to innovation. Mercedes' move isn't just a sales tactic. It has the potential to reshape how cars are designed, built, and priced for years to come. At the same time, Wall Street analysts are tracking another critical indicator: luxury inventory cycles. Historically, when luxury inventories climb past 70-80 days, the entire sector enters a defensive posture. Today, some Mercedes models are already surpassing that mark, and dealers are signaling that more units are inbound from overseas plants. If inventory continues to build, Mercedes may resort to even more aggressive incentives, including loyalty bonuses, conquest incentives, subsidized leases, and deeper cash rebates on slow-moving trims. This would reinforce the narrative that demand is weakening, creating additional volatility across auto stocks. But despite these risks, the Mercedes discounts present a unique opportunity for consumers who understand the timing. This moment in the market is rare. High inventory, high incentives, and rising competition all converging at the same time. Strategic buyers who track dealership stock, understand model year transitions, and negotiate assertively can secure deals that were unthinkable just a year ago. For those entering the market, this is arguably the strongest buyer's environment since the aftermath of the 2008 recession. However, the real uncertainty lies in how long this window will remain open. If Mercedes successfully clears out excess stock and stabilizes demand, the company could quickly tighten incentives again, especially on high-demand models. That means buyers need to evaluate their needs carefully, jump in now for a guaranteed discount, or wait for potentially deeper deals with reduced availability. Yet one more dimension remains: how international markets will react to Mercedes' strategy and whether a global price adjustment is about to unfold. International markets are already showing early signs of following Mercedes' lead. In Europe, several dealers have begun quietly offering unadvertised incentives on models that were previously considered untouchable, including high-margin SUVs and plug-in hybrids. In the Middle East, where luxury demand is typically more resilient, distributors are beginning to lean on value-added packages, extended warranties, and discounted maintenance plans to maintain sales velocity. And in Australia, reports suggest that some Mercedes models are staying on lots significantly longer than projected, forcing dealerships to explore more flexible pricing strategies. If this global pattern strengthens, Mercedes may find itself orchestrating a synchronized international discount campaign, something major luxury brands almost never do. This would mark a dramatic shift from the traditional market-by-market incentive approach and signal that the company is facing broader structural challenges rather than isolated regional issues. Such a move would also pressure other luxury brands to follow suit worldwide, potentially sparking the first coordinated luxury price realignment in decades. Meanwhile, analysts warn that a global discount wave could impact Mercedes' residual values across multiple continents. Lower residuals translate directly into higher lease payments in the long run, affecting future affordability even if upfront prices drop today. This may create a paradoxical situation where short-term deals are attractive, but long-term costs rise because depreciation accelerates. Financial institutions are already recalibrating their models, and if they expect deeper discounting cycles, leasing will become more expensive, forcing buyers to reconsider ownership strategies. For current Mercedes owners, the picture is mixed. On one hand, falling new car prices could put pressure on the resale value of their existing vehicles. On the other, if the company uses this period to aggressively refresh product lines and strengthen technology offerings, long-term brand equity could rebound once the discount era stabilizes. Owners who plan to trade in may face reduced equity, but those who hold onto their vehicles longer may feel less impact. This dynamic is adding another layer of complexity to an already volatile market. Buyers, meanwhile, are increasingly asking one decisive question: is now the smartest moment to buy a Mercedes in years, or could waiting unlock even deeper discounts? The truth is nuanced. Current pricing is attractive and, for many, compelling enough to act, but the underlying inventory trends and global pressures suggest that Mercedes could deepen incentives if sales fail to recover by the end of the next quarter. The optimal strategy depends on each buyer's timeline, flexibility, and willingness to monitor inventory closely. Still, the broader story remains unresolved. Mercedes' bombshell move has set off a chain reaction, but the final outcome will depend on how aggressively the company adjusts its global strategy and how competitors respond in the coming months. Competitors are now entering a critical decision window. BMW, Audi, Lexus, and Volvo cannot ignore what Mercedes has unleashed. If they maintain current pricing, they risk losing market share to a suddenly more affordable rival, but if they match or exceed Mercedes' discounts, they risk eroding their own margins and damaging their premium positioning. This is the luxury industry's nightmare scenario, being forced into a price war not by choice, but by survival. BMW is the most vulnerable in the immediate term. The company relies heavily on strong US demand, and many of its core models, like the X3, X5, and 3 Series, are already experiencing pressure from rising inventories. If Mercedes' discounts begin siphoning high-income shoppers away, BMW may be forced to offer strategic incentives within weeks, not months. This would mark a dramatic shift for a brand that has fought hard to maintain pricing discipline. Audi, on the other hand, struggles with inventory turnover and slower EV adoption in the US market. Mercedes' price cuts could further expose Audi's weaknesses, especially in segments where the company already lags behind. Analysts predict Audi may quietly roll out dealer-level incentives rather than publicizing major discounts to avoid signaling distress. But whether those quiet incentives are enough remains uncertain. Lexus is the wild card. While it operates with exceptional reliability and brand loyalty, Lexus vehicles have seen significant price increases over the past 3 years. If luxury buyers suddenly find themselves choosing between a discounted Mercedes GLE and a full-price Lexus RX, the psychological value equation shifts. Even if Lexus doesn't directly discount, it may need to introduce added value packages, extended warranties, or reduced financing rates to stay competitive. Volvo and Genesis could also leverage this moment to grow rapidly. Genesis especially has the inventory, product quality, and pricing flexibility to capitalize on a luxury pricing reset. If Mercedes and BMW reduce their prices, Genesis could expand its footprint dramatically by positioning itself as the value luxury alternative with class-leading interiors and warranties. But beyond the US market, this shift could reshape global brand hierarchies. Mercedes has long been the benchmark for luxury. By discounting aggressively, it tacitly acknowledges that the market is changing faster than legacy automakers can adapt. If the company does not manage this transition carefully, younger brands, especially tech-forward EV manufacturers, may seize the narrative and redefine who leads the luxury sector over the next decade. For buyers, the strategic landscape is evolving in real time. Those who understand how automakers react to market shocks will be able to time their purchases more effectively and secure some of the strongest deals the luxury market has offered in years. But the ultimate question still looms: how far is Mercedes willing to go to maintain sales momentum?